In the late 2010s, one company epitomized the dizzying excesses of the startup world: WeWork. It wasn't just a company. It was a phenomenon, a global community, a movement promising to elevate the world's consciousness. In early 2019, investors, spearheaded by the Japanese conglomerate SoftBank, valued this company at a staggering $47 billion. It was one of the hottest startups on the planet, a so-called unicorn, ready to go public and change the world. But strip away the neon signs, the free beer, and the lofty mission statements, and what was WeWork, really? It was a real estate company. Its business model was simple: sign long-term leases, often for 15 to 20 years, on massive office buildings. Then it would renovate those spaces and rent them out with short-term flexible contracts, sometimes as little as 30 days. This is called lease arbitrage, and it's a high-stakes, capital-intensive business. The key distinction, the fatal flaw, was that WeWork was selling a product with real estate margins, yet it demanded a tech company valuation. The logic was simple, if delusional. If you grew fast enough, the fundamental business risks wouldn't matter. The secret formula that drove the whole circus was simple: charisma plus capital equals delusion. At the center of this swirling vortex of hype was the co-founder, Adam Neumann. Standing 6'5", charismatic, perpetually barefoot in the office, and fueled by a messianic conviction, he was a salesman investors, especially SoftBank's Masayoshi Son, could not say no to. Neumann didn't pitch desks. He pitched a physical social network and a life-changing experience. But beneath the visionary posturing was a shocking level of self-dealing and personal extravagance that burned through investor cash at an unimaginable pace. Adam Neumann treated the company like his personal piggy bank. He insisted the company buy a $60 million Gulfstream G650 private jet for executive travel, which he reportedly used like a party bus, with one infamous story involving a chartered flight being recalled after a cereal box allegedly containing marijuana was discovered. He cashed out hundreds of millions of dollars of his own stock, long before the company ever went public. The most brazen example of his disregard for corporate governance was his personal enrichment from the company's own assets. He engaged in numerous conflicts of interest, including buying buildings and then leasing them back to WeWork, and most notoriously, after rebranding the company to the We Company, Neumann personally charged his own startup $5.9 million for the trademark rights to the very word we. This wasn't a governance failure. It was a total collapse, enabled by a board more concerned with not upsetting their visionary founder than with protecting investor capital. The primary enabler was SoftBank, led by Masayoshi Son, who poured over $10 billion into WeWork. Son, who had backed titans like Alibaba, believed in the founder first. His capital infusion validated the fantasy and accelerated the cash burn to impossible, unsustainable levels. To keep employees motivated and the atmosphere electric, Neumann created a distinct culture, often described as cult-like. He fostered a work hard, party harder environment where the line between work and life didn't just blur, it vanished entirely. The company's mission statements weren't just about real estate. They were quasi-spiritual. Employees were expected to attend mandatory, alcohol-fueled annual summer camps, multi-day festivals featuring A-list musical acts, motivational speeches that lasted hours, and heavy pressure to embody the we lifestyle. The atmosphere bordered on the surreal. Neumann was known to take tequila shots with job candidates during interviews. But the underlying message was that employees were part of something greater, something that would change the world, and that meant prioritizing the mission over everything else. This cult of personality, however, served as a powerful distraction. It kept thousands of hardworking employees motivated by stock options and a sense of belonging while the business's financial foundation was rotten. The focus on elevating the world's consciousness was ultimately a smokescreen for a failure to achieve the most basic goal of any company: sustained profitability. The moment of truth arrived in August 2019. WeWork filed its S-1 document, the required public prospectus to go public. For the first time, skeptical analysts and the public saw the unvarnished financials. The numbers were staggering. The company was hemorrhaging cash, posting a $1.6 billion loss on $1.8 billion in revenue in 2018. The spectacular financial mismanagement, the governance issues, and the conflict of interest with Adam Neumann were all laid bare. The market immediately recoiled. The $47 billion valuation evaporated in a matter of weeks. The planned IPO was pulled. The company's value plummeted to under $8 billion. The board, under pressure from SoftBank, finally acted. Adam Neumann was forced out, but not without one final, infuriating act. He walked away with a severance and exit package valued at an estimated $1.7 billion. The ultimate case study of a founder failing upward while thousands of employees lost their jobs and saw their stock options become worthless. The damage was irreparable. After years of struggle, massive layoffs, and a pandemic that shattered the office market, WeWork finally filed for Chapter 11 bankruptcy in late 2023. The entire saga had cost investors tens of billions. The ultimate lesson of the WeWork spectacular is a timeless cautionary tale about the myth of the visionary founder. The story proves that no amount of charisma, free tequila, or talk of elevating consciousness can override fundamental business math. When a company with multi-billion-dollar losses is priced like a software giant, the market isn't buying a business. It's buying a dream. And when the dream is built on long-term debt and a dangerously unchecked ego, the crash is not only inevitable, it's catastrophic.